Well, what we see is, because I was in London and in Paris this afternoon, it's pretty interesting. I mean, everybody was saying to Germany, it's boring, it's a stable market, and now we see absolutely the opposite of the international investors. They say, okay, we like Germany because it's boring, because we have, and that's exactly the things, we have a low volatility but high liquidity. That's what investors like. And this up and down are interesting when you can play the cycle, but it's also the risk you lose money. And currently, what all international investors want all over the world is this low volatility and high liquidity. So if you go into the markets, and the biggest markets in Europe are London and Paris, but then in the top 10 you have Munich, Frankfurt, Berlin and Hamburg. And these are big markets, liquid markets, and that's what investors like. And therefore we see a lot of capital inflow currently, and we will see it also next year in the German market.
I think there is a macroeconomic rationale that even more money gets into Germany. First of all, I think that the end of quantitative easing on the American side will come. And it is not so relevant from my point of view whether that end happens in March, in April, in May, or whenever it is, whether it happens fast, which I don't think is very likely, or whether it happens slow, but it will lead to increased interest rates on the American side of the world. I think that we will have a larger yield spread than on the bond side and on the public interest side on America compared to Europe. That by itself should lead to a stronger dollar compared to the euro, simply through the currency exchange rates and the currency buying schemes that basically fundamentally exist. And that will, and we see that already in prospects and in talks that we hear and that we do with American investors, that will lead, not only that, but that will have an additional effect on Anglo-American money, American money, Canadian money, getting into Europe. And if you look at Europe, then I have the second slight divertive view with regards to that. Where would you go? You made the right point. Boring is attractive. Of course, if you don't like roller coaster with your money, you may like it personally, a roller coaster, but with your money, you may really stick to a more stable place. First of all, Germany's there. Second of all, if you look at Western Europe, the German GDP outlook, or let's say in the stable Central European countries on the Western side, is by far the best. So this is another place to go. Plus, you said, and this is where I differ a little bit, we don't have to worry about inflation. In Europe as a whole, I fully agree. I don't think that we will have an average Eurozone or even European inflation which is significant. It will be low. I think it will be 2% or less. But what does that mean for Germany? We will have cheap money continuously. We see deflationary tendencies in some southern European countries. You have -2 in Greece currently, and this is necessary simply to get prices down to be attractive for export again. That must be funded, and that must be supported for a longer period. That means what Germany may need higher interest rates to keep inflation in check, and when inventories go lower and when machinery is used to a higher extent, that may not be feasible. And if I would be the European Central Bank and if I would target 2%, and if I have -2 in Greece, I could afford 3% in Germany. So I assume that we will have an inflation spread among the Eurozone countries with higher inflation in Germany. If that happens, that's another trigger for money to come. We will have indexations much closer to happen than we had it before. I promise not to speak more than maybe 2 or 3 minutes, but this is why I think money will come in out of these macroeconomic factors, and I'm absolutely glad with everybody here in the room to discuss that further, and I'm glad if somebody contradicts, then I
Good.
Okay.
Thilo,
maybe one more argument from my side is, of course, diversification. For example, TIA Craft currently hold around about $50 billion in real estate investments, and only $2 billion of that 50 billion are outside the US. So sophisticated investors, and this also counts for Australian and Asian investors, need to diversify. when we talk to our German clients, for example, smaller insurance companies, pension funds, they feel more safe in Germany anyway, and they are not willing to diversify even into the other European markets where they at least know the markets or the countries from their holidays. So they don't need to diversify, they stay in Germany and say, okay, either we want very stable investments and they invest into German residential, or we do want to have a little bit higher returns and they are investing into retail warehousing or logistics, so they stay in Germany. But from the sophisticated international investors, they need to diversify, and that's why a big part of that money will come to Germany, and the only question is where will it be finding a home, and that will drive prices further in the very core sector, and we
all
sure
offer them
about that.
homes.
Yeah.